What about 2025 and how is it likely to pan out? That's the question we are posing to Manish Sonthalia. He's, of course, the Director and Chief Investment Officer at MK Investment Managers. Manish, hi, good to be speaking with you. And first up, season's greetings. We are perhaps ending, the year on a bit of a somber note because last couple of months have been all about correction. But do you see this correction protrude into 2025 or is it going to be a different picture?
So I think everything hinges on what happens in the budget, and we are looking at the budget exactly 1 month's time. And of course, the problems are well known. It is the slowdown in consumption, it is the slowdown in spending. So these things need to be addressed. Otherwise, corporate earnings growth don't look like having more than a 10 to 12% growth. So I think it is again going to be back-ended in terms of how the growth picture looks like, because FY25 is a given, is a soft year in terms of both the market performance. You have a 10% appreciation in calendar 24, and we are looking at 10 to 12% earnings growth in calendar 25 as well. So from that point of view, if something needs to be done, it has to come at the behest of the government. Otherwise, I think markets are not going anywhere. Markets will meander in a small range between 22,000 and 25,000 as we speak. So all eyes on the budget, I would say.
Okay, all eyes on the budget. And if we were to look at narrowing it down, Manish, to some sectors that would possibly benefit from that, do you think that infrastructure would be the one to watch out for?
No, exactly not, because we are hearing that government intends to contain fiscal deficit at 4.5% of GDP. So obviously, this means two things: either you have an increment in revenue, or you have a cut down in expenditure. So if you have a cut down, because if your economy is growing at 11-12% nominal, that is the best in terms of revenue collection that you should build in. But if you're building in a cut in the expenditure, that does not augur well for government spending. So, and of course, you have to balance between consumption and investment, because government has to do the heavy lifting in terms of giving some leeway in terms of taxation, so that the consumption revives for the consumer. So, of course, if this means that government has to cut down on government expenditure, and that does not augur well for the infrastructure companies. If you look at post the COVID, both the corporate sector and the government have been reducing their debt. It is only the household leverage which is going up. And the need of the hour basically is to actually maintain fiscal deficit at existing numbers, because then you are actually signaling to the market that you have a preference for growth over inflation. Currently, it is all about inflation over growth. And in that respect, if there was an intent to cut down fiscal deficit, then does well augur very well for infrastructure spending.
Okay, thanks for that take on infra. But Manish, also wanted to get your take on the entire defense space. It's been up in a buzz recently. A couple of brokerage notes also turning positive. We're hearing that defense spending in Q4 is going to pick up largely as well. In light of the budget that's upcoming, how are you seeing the defense sector shaping up?
So basically, all this is known that our order book really starts to build up in the fourth quarter. And of course, defense companies do actually, the prices move in tandem with the order book. So there's nothing quite extraordinary that is going to get revealed during the Q4, because an anticipation of a particular order book is made at the beginning of the fiscal year. And then it's just a reiteration of those numbers as we progress into the 4 quarters. Of course, there's going to be some bump up this time around. But is it very extraordinary? I wouldn't think so. And if you talk about the build-up in defense budget, I mean, we talked about 6.25 lakh crores last budget. Maybe some increment would happen this year. But again, out of that, 80% is all revenue expenditure, 20% is capital expenditure. And within that, you'll have all the shipping companies, you'll have all the HALs of the world and BELs of the world get the order book. Out of that 20%, it does not really move the needle from a near-term perspective, because these sectors are priced to perfection. That is the whole problem. It's not that the defense sector and the profit growth is not going to be there for the next many years to come, but these sectors, these stocks are priced to perfection. There's still room for downside in these stocks.
Okay, so that's the latest coming in as far as defense pack is concerned. Manish, I was going through some of your portfolios and it does seem like you are quite, incrementally invested into pharma. And that's largely towards the CDMO or the manufacturing side, whether it's Divi's, whether it's Sun Pharma, whether it's Ajanta Pharma, etc. Talk to me about the thought process here. And are you not looking at, let's say, healthcare, diagnostics, etc.?
So the portfolio which you're referring to is my colleague's portfolio. But yeah, you're right that we are overweight pharma in a big way, and particularly the CDMO space. Of course, there's some disappointment on the Biosecure Act also, because it was expected that the Biosecure Act will come about sooner than later. But now I think we'll have to do some waiting. It's not going to be that easily brought. And of course, if it is brought, then there could be some alterations to the original act. We don't know, but the whole point is that the CDMO space, the share of business which China gets and the share of business which India gets, there is a huge difference. Even if there is an increment that is to happen in the CDMO space, India will stand to benefit. And that's the whole story in the CDMO space. And the size of the opportunity is very, very big. Some $200-300 billion. India is just about $6-7 billion in total revenue. And of course, this has all the possibilities to go up with or without the Biosecure Act. Without the Biosecure Act, it will take slightly more time. But given the amount of activity that is happening in the new discovery molecules, I think India has a right to win out here. We have chemistry skills, and that is the whole play in the CDMO space. Marquee names are there across our portfolios, and we continue to bet heavily, even on the new listings that have come about, even evaluating them quite closely.
Can you just elaborate a little bit more on that? Wanted to get in your take on some of these new listings, because the year gone by has been a big bang one when it comes to a lot of IPOs that have hit the market. So what is it that's looking promising within that space, or what are the parameters that you check before investing in some of these companies?
So just for record, India has seen the largest number of IPOs in calendar year 24 in the entire world. And that's one out of every 4 IPOs have happened in India. And in terms of value, it's 9% of the total value of IPOs that have happened globally have happened in India. So India had it very good this year. Of course, one could say very comfortably that not all IPOs are worth investing in. But there's sheer momentum in the IPO space. One needs to be careful. But there are some very good companies also that are coming out with IPOs, and valuations is something to be thought about, and allocations, particularly when these IPOs are subscribed more than 100 times, it basically boils down to buying on the listing day or thereafter, after the stock has moved up 50, 60, 100%. That's the whole call. But I think the pipeline of IPOs continues even in calendar year 25. Whole lot of issues are lined up. But I think the areas where we would be quite comfortable is your information technology, is your BFSI space, is your platform companies, it's your capital market entities. Some of the niche plays in even consumer space, etc., are the areas where we'll be closely looking.
Manish, point taken. And while we're talking about the entire consumer space, one name that I'm seeing in a portfolio of yours as a top holding is Zomato. Not really surprised to see Zomato, but also not expecting to not see Swiggy make it to this list. What's making Zomato much more attractive than Swiggy? Because Swiggy has also been innovating, if not at a higher pace than largely at the same pace that with Zomato has. They've also had a couple of recent rollouts. The stock seems to be doing well over the last 1 month, and ever since its listing, we have very bullish brokerage notes coming in for Swiggy as well. What's making Zomato more attractive than Swiggy to hold in your portfolio right now?
So not specifically commenting on Swiggy because regulation prohibit us from commenting about stocks that are not a part of our portfolio. But I would look at the entire space like this. The TAM, the size of the opportunity is humongous. There is room for everybody. You have many more players apart from Zomato who actually enter both the quick commerce space and the food delivery space. And the fast food delivery space also, the cafe Zeptos of the world, so to speak. And, even Zomato has come out with a bistro, and likewise for Swiggy. And you'll have many more come through in the form of, let's say, JioMart or a Flipkart, also announcing the quick commerce model. Size of the opportunity is very good. In retailing, and this be true for any form of retailing, you got to get your unit economics right. And if you get your unit economics right, that is to say per unit order or per unit quick commerce transaction, more than cost of capital, then the sky is the limit for you. And I think Zomato has the first mover advantage. They have got the unit economics right. They have broken even. They are making contribution margin which are positive, and now it's only about expansion into tier one, getting economies of scale. The other players, have not really got that right just yet. And even as we speak, the turnover on these companies are that, let's say, Swiggy is also 50% market share in food delivery, or let's say 45% market share, and Zomato is a 55% market share. You haven't got your unit economics right, then you'll have a tough time going forward. So that is not to say that they can't get it right, but I think we would like to bet on players which have already got it right, because the size of the opportunities available for everybody and the TAM is just too big. So, anybody and everybody can win who can get the supply chain and the unit economics right. But more comfortable in public portfolios in companies which have already demonstrated profitability and growth. So that's the reason why we have Zomato as a preferred pick in this space.
The TAM remains strong, but it's just that one has a lot more proven track history of success, and that's why you're favoring that one, at least this point of time. I'm very intrigued to ask you the question on IT, Manish, because you talked about how you're positive on the sector. Now, on one hand, you're talking about how it's going to be a year of only 10-15% kind of earnings growth. Nifty is going to be range bound between 22 to 25,000. When it comes to IT, the earnings are going to be somber, maybe let's say, very low double digit to high single digit. And at the same time, valuations aren't comfortable either, plus the disruption of Gen AI. In all of that context, how does IT stack up to your buy list then?
So we are talking everything relative out here, that these are sectors which are relatively going to outperform the rest of the sectors in terms of both the earnings growth as well as the valuations. One key parameter on the macro side is your currency. And you're right that ID companies will at best report, mid to high single digits sort of a constant currency revenue growth in calendar 25. But this is coming on the back of a low base. And, the last 2-3 years has been bad for the IT space. There has been a lot of order book position that was built in, but it was never getting translated into revenue. For the first time after the elections in US, which are getting over, you'll see a lot of discretionary spend come through. And obviously, we are hearing that tax cuts are also going to happen in the US. A lot of impetus on technology spending is going to happen in the US. And of course, a rub-off effect of all these things will also come to Indian IT vendors, as well as the Global Capability Center, GCCs in India. So I think on a relative basis, you combine all these three things: constant currency revenue growth of which is actually going to see an increment. We have heard that from Accenture that they have upped their guidance. The guidance is going to be really relatively better than what we saw in the previous quarter. A whole lot of that peak into discretionary budgets of clients of IT vendors will come through January to March quarter. But nonetheless, the commentary would signal a lot of things. You are looking at currency depreciation. You're looking at tax cuts come through in the most developed market, which is US, and technology spend boost, which is coming through. So it's not lights on. It's basically discretionary spend. The environment changes for the better, and on a relative basis, when we compare this year to last year, it is much better. Of course, valuations are relatively full, but valuations are relatively full for almost all sectors in India. There's not even one sector in India which is not full in terms of valuation if you take it from a sectoral point of view. So on a relative basis, when you are looking at the currency depreciating another 3 to 4% in the next 6 to 9 months, this offers a high margin of safety when it comes to your sectoral picking, is how I look at it.
Okay, so that's the case coming in. IT looking better on a relative basis. But then what about the entire public sector kind of entities? In the sense that this year's start was great for them, then they cooled off a bit. Do you expect a bit of a revival in some of these names come 2025? How does the risk reward look like?
See, the government is talking about heavy lifting in terms of expenditure come through in the second half of this year and maybe even after the budget. All of this spend is going to happen through the public sector entities, and public sector as a whole is relatively very cheap in terms of valuations. And from that point of view, I think the risk is to reward is very, very favorable. On top of that, these guys are actually going to pay very good dividends. So if we are looking at some island of safety in terms of valuations, this is one space. Of course, the idea is to be with those spaces in the public sector where there is a monopoly or monopolistic companies. And I would even look at public sector banks, because even though the growth rates in NII, net interest income for the second quarter, was lower than the private sector banks, in terms of relative valuation also they are much cheaper than private sector banks. And of course, the banking sector as a whole looks very favorably suited in terms of valuations and growth. So public sector banks plus monopolistic public sector entities, I think that the margin of safety is very high, given that all the public sector spending is going to happen through the public sector units. The government spending is going to happen through the public sector units, and that's why plus high dividends. So this is one area to be kept on mind selectively.
Just on a departing note before we let you go, also want to get your sense on the entire FMCG space, because I'm not seeing any pure play FMCG names, or a couple of consumption names, yes, but not seeing pure play FMCG names across your portfolio. What's your outlook on the likes of HUL, a Tata Consumer, a GCPL? GCPL has rather already given a very weak Q3 update even before the quarter has ended. Do you think recovery is still a little far away for a bunch of these names, given that rural is recovering but urban demand has now started slowing down?
Absolutely. I mean, consumption as a whole is weak, both the discretionary side on most of the categories in the discretionary side, and even staples has been quite weak because we are really looking at very little value growth come through and even lesser volume growth. And rural is recovering at the margin, but urban is getting suppressed. So from that point of view, the risk is to reward in terms of valuation still seems very unfavorable. If the valuations were to correct, of course, this is one area to look at. But I would believe that given the growth on most of the FMCG names, a high single digit sort of revenue growth, so to speak, and of course, the whole story is about premiumization. But we are also looking at an inflationary scenario. Please understand that if rupee was to depreciate, then we are going to import a lot of inflation, and margins is going to be one area to be concerned about going into the future. And given the way the things are, it looks like that rupee is likely to going to depreciate. So from that point of view, margin headwinds will be one area for all the corporates. And particularly so even in the case of FMCG, they will be a headwind to your net profit numbers. And given the valuations, of course, these are high quality cash flows, but there's no growth. So from that point of view, significant underweight on the FMCG space.
Pure play consumption and painting quite a bit of somber picture there, Manish. Maybe the sage advice that everybody needs right now to calibrate and moderate their expectations, because you're talking about a 10 to 15% earnings growth, and of course the Nifty expected between 22 to 25,000. So moderate your expectations and play the game on a relative basis. That's the word coming in. Thanks, Manish, for making time, and wishing you the best of 2025.
Likewise to everybody at ET Now and all your viewers.
Thanks so much for that. But
if you like this video, then like, share and subscribe to ET Now.